really was. So all these are issues. Inherent risk is basically the assessment of the likelihood that there are material misstatements before considering internal controls. It's based on your discussion or interviews with management, your observations of the company, how certain procedures are handled, your knowledge of the company, your prior audits, discussion perhaps within the industry with other players in the industry. And it's inversely related to detection risk and directly related to evidence. So the higher the IR, inherent risk, which means you have to put greater risk and then lower the detection risk. Going back to that balanced equation here, where you have the AR. See, the AR is 3%, let's say, so the IR, CR, and DR are all fluctuating based on the AR assessment. And factors affecting account inherent risk include the dollar size of the account. So the higher the dollar amount, the more chances are of risk. Liquidity, the more liquid the account, the greater the risk. The volume of transactions, the greater number of transactions, the greater chance there is of a risky situation. Complexity of the transactions, if there's new accounting pronouncements affecting it. So, for example, in the case of leasing, for example, airlines right now should be under scrutiny because the lease accounting rules are changing and how they're stated in the financial statements. So this is a big area of risk right now for all the airline companies and, let's say, trucking companies, anybody that leases most of their equipment. And it's also subjective estimates are also a big part of this. So these are all